Wall Street, more than just a street in lower Manhattan, stands as the enduring metaphor for the global financial system, a dynamic epicenter where capital converges, fortunes are made and lost, and the intricate dance of risk and reward plays out with relentless intensity, shaping economies and individual destinies across the globe. It is here, within this vibrant, often turbulent environment, that the fundamental principle of finance, the inseparable relationship between risk and reward, finds its most dramatic expression. From its humble beginnings to its current status as a titan of global finance, Wall Street's history is a compelling narrative of evolving understanding and increasingly sophisticated management of these two intertwined forces. This journey through time reveals how intuitive judgments gradually yielded to rigorous mathematical models, transforming the art of speculation into a science of calculated probability. Understanding this evolution is not merely an academic exercise. It is an essential guide for any modern trader seeking to navigate the complex currents of today's markets. The lessons embedded in Wall Street's past offer invaluable insights into anticipating market behavior, mitigating potential losses, and maximizing strategic gains. The historical roots of Wall Street stretch back far beyond the gleaming skyscrapers and bustling trading floors of today. Its very name originates from a defensive wall built by Dutch settlers in New Amsterdam in the 17th century, a barrier against indigenous tribes and English colonists. Though the wall itself was eventually dismantled, the street it defined retained its name, destined to become the heart of American finance. The earliest forms of commerce along this street were informal, driven by individual agreements and personal trust. However, the necessity for a more organized market soon became apparent. A pivotal moment arrived in 1792 with the Buttonwood Agreement, where 24 stockbrokers and merchants gathered under a buttonwood tree to establish common rules for trading securities. This simple agreement marked the genesis of organized securities trading in the United States, laying the groundwork for what would eventually become the New York Stock Exchange, a key institution that would profoundly shape the future of global finance. In these nascent stages, the understanding of risk was largely intuitive, heavily reliant on an individual's reputation, trust among participants, and a keen, albeit unquantified, sense of market sentiment. There were no complex algorithms or sophisticated models. Decisions were made based on direct observation, personal relationships, and a rudimentary grasp of supply and demand. This early period highlights a fundamental truth. Risk has always been inherent in financial transactions, even when its nature was perceived through a more qualitative lens. The concept of risk and reward has undergone a profound evolution, transitioning from abstract philosophical notions to rigorously quantifiable metrics. Early economic thinkers, particularly those of the classical and neoclassical schools, provided foundational insights. Economists like Alfred Marshall, for instance, considered risk an integral component of profit and cost, differentiating between personal risks borne by individuals and entrepreneurial risks undertaken by businesses. For these pioneers, risk was often viewed in terms of the potential for variation in expected returns, a concept encapsulated by the idea of marginal utility, the additional satisfaction or benefit derived from consuming an additional unit of a good or service, applied metaphorically to the potential fluctuations of financial outcomes. However, the inherent limitations of purely qualitative assessments soon became evident. As markets grew in complexity and the scale of financial transactions expanded, there emerged an undeniable need to move beyond intuition and subjective judgment. The imperative shifted towards developing robust methods for the qualitative and, crucially, quantitative analysis of risks. The drive was to objectively measure the magnitude of potential losses and gains, allowing for more informed and rational decision-making. This transition marked a crucial turning point, setting the stage for the development of the sophisticated mathematical tools that define modern financial analysis. The journey from conceptual understanding to precise measurement was a response to the growing recognition that effective risk management was paramount for stability and growth within the burgeoning financial system. Wall Street's history is punctuated by a series of dramatic crises, each serving as a harsh but invaluable lesson in the nature and management of risk. from the earliest speculative manias to the modern global financial meltdowns. These events have reshaped regulatory frameworks, investment strategies, and the very understanding of systemic vulnerabilities. The 19th century witnessed numerous financial panics and bubbles, such as the canal mania or railroad speculation, which were early, stark examples of uncontrolled risk. These periods demonstrated how collective irrational exuberance could inflate asset prices far beyond their intrinsic value, inevitably leading to devastating crashes. However, it was Black Thursday in October 1929, followed by the Great Depression, that truly forced a fundamental reevaluation. This cataclysmic event exposed the profound dangers of systemic risk, the risk of collapse of an entire financial system or market, and underscored the urgent need for robust regulation to prevent such widespread devastation. The aftermath led to the creation of institutions like the Securities and Exchange Commission (SEC) and the implementation of significant legislative reforms aimed at restoring investor confidence and market stability. Decades later, the global financial crisis of 2007 to 2008 served as another painful reminder of systemic fragility. This crisis, fueled by a combination of lax lending standards, complex financial engineering, subprime mortgages and their securitization, and a prolonged period of low interest rates, demonstrated how interconnectedness within the financial system could amplify localized problems into a global contagion. The collapse of major financial institutions and the subsequent government bailouts highlighted the consequences of widespread, interconnected risk and the critical importance of macroprudential policy. More recently, crises involving regional banks have caused fresh waves of panic on Wall Street, illustrating that even seemingly localized failures can trigger broader market anxieties, prompting rapid withdrawals and concerns about deposit insurance and overall financial health. Each of these crises, from the earliest speculative bubbles to the most recent banking scares, has invariably led to a profound reevaluation of approaches to risk assessment and management. They have underscored the critical role of corporate governance, emphasizing the necessity for boards of directors to actively develop and implement strategies that anticipate and mitigate potential risks. A key distinction that emerged from these lessons is that between systemic risk, which threatens the stability of the entire financial system, and systematic risk, or market risk, which refers to the overall market risk that cannot be diversified away, affecting all investments to some degree. Understanding this differentiation is crucial for both regulators and individual investors in constructing resilient portfolios and policies. As we delve deeper into these historical patterns, it becomes clear that understanding the past is not merely an academic exercise, but a crucial tool for navigating the present. Indeed, the very fabric of Wall Street's history is woven with the tales of individuals who witnessed and shaped these transformations. For those who seek to truly grasp the evolution of this financial powerhouse, extending beyond the raw data to the human stories and market machinations that defined entire eras, a remarkable resource offers an unparalleled journey. Consider the profound insights offered by 50 Years in Wall Street, an illustrated memoir that chronicles half a century of this financial epic, from the panic of 1857 through the Gilded Age. It is a vivid tapestry woven with the experiences of prominent financiers and the intricate dance of market manipulations, providing a rich, personal perspective on the forces that shaped our modern financial landscape. This isn't just history. It is a window into the minds and methods of those who built and battled on Wall Street, offering lessons that resonate even today. You can explore this invaluable historical account and truly immerse yourself in the saga by finding the links to this essential 2-volume set in the description below. The evolution of financial markets necessitated a move from qualitative assessments to the rigorous application of mathematics to quantify risk and reward. This quantitative analysis forms the bedrock of modern trading and investment. At its core, it involves the systematic use of numerical data and statistical methods to evaluate potential risks. A fundamental concept for any trader is the risk-to-reward ratio, a quantitative indicator designed to balance potential losses against potential gains. For example, A 1 to 3 risk-reward ratio signifies an expectation of earning $3 for every dollar risked, providing a clear framework for decision-making before entering a trade. This simple ratio, while powerful, is just the entry point into a vast array of sophisticated mathematical models and theories that have revolutionized finance. One of the most influential frameworks is modern portfolio theory, MPT, pioneered by Harry Markowitz. MPT provides a mathematical means to construct an optimal portfolio of assets, aiming to achieve the maximum expected return for a given level of risk, or conversely, to minimize risk for a specified expected return. It emphasizes diversification, not just across different assets, but across assets with varying correlations, to reduce overall portfolio volatility. Building upon MPT, the CEN, Capital Asset Pricing Model, CAPM. Developed by William Sharpe, John Lintner, and Jan Mawson, offers a method for estimating the expected return of an asset, taking into account its systematic risk, often represented by the beta coefficient. Beta measures an asset's sensitivity to overall market movements. A beta greater than 1 indicates higher volatility than the market, while less than 1 suggests lower volatility. Another critical tool for risk management is value at risk, VAR. VAR is a statistical technique used to estimate the maximum possible loss that a portfolio could incur over a specified time horizon, given a certain level of confidence or probability. For instance, a VAR of $1 million at a 95% confidence level over 1 day means there is a 5% chance that the portfolio could lose more than $1 million in a single day. While widely used, VAR has limitations, particularly its inability to capture tail risk or extreme low-probability events. The Black-Scholes model, developed by Fisher Black, Myron Scholes, and Robert Merton, represents a revolutionary advancement, particularly in the pricing of options. This model provided a closed-form solution for valuing European-style options, allowing for a quantitative assessment of the risks associated with derivatives. Its impact on the derivatives market was profound, enabling more efficient pricing and risk hedging. Beyond these foundational models, statistical methods play a crucial role. Analyzing the fluctuations of financial indicators through standard deviation helps measure volatility. More advanced techniques like semivariance focus specifically on downside risk, quantifying unfavorable deviations from the expected return, which is often more relevant to risk-averse investors. For complex scenarios, Monte Carlo simulation and decision tree analysis are employed. Monte Carlo methods involve running thousands or millions of simulations using random variables to model the probability of different outcomes, providing a comprehensive assessment of risk and its potential impact. Decision trees, on the other hand, offer a visual and analytical framework for evaluating choices, their potential consequences, and associated probabilities in sequential decision-making processes. Finally, understanding the risk premium, the extra return an investor expects for taking on additional risk, is vital. Methodological approaches to estimating this premium are used when discounting future cash flows, ensuring that the time value of money and the inherent risk of an investment are appropriately factored into valuation. These mathematical tools collectively empower traders and investors to move beyond mere speculation, enabling them to make data-driven decisions based on a robust understanding of probabilities and potential outcomes. Despite the elegance and power of mathematical models, the human element, particularly emotions, continues to exert a profound influence on market decisions. Wall Street's history is replete with examples where investor behavior, often driven by fear and greed, has defied rational expectations, becoming a foundational subject within behavioral finance. The concept of emotional value attached to assets, alongside the influx of speculative capital, frequently distorts market prices, leading to deviations from what efficient market models predict. While efficient market hypothesis posits that asset prices reflect all available information, thereby making it impossible to consistently achieve abnormal returns. The reality of market bubbles and panics suggests a persistent irrationality. Traders, despite their training and access to data, are susceptible to a range of cognitive biases. These include confirmation bias, seeking information that confirms existing beliefs, overconfidence bias, overestimating one's abilities, and anchoring bias, over-relying on the first piece of information encountered. The collective psychology of market participants, often manifesting as a herd instinct, can amplify these biases, leading to widespread buying frenzies that inflate asset bubbles or panic selling that triggers market crashes. Understanding these behavioral dynamics is crucial, as they can override even the most meticulously calculated mathematical models, reminding us that finance is as much about human psychology as it is about numbers. Recognizing and mitigating one's own biases, therefore, becomes an essential, albeit challenging, aspect of successful trading. The financial landscape of Wall Street is in a state of perpetual flux, driven by technological advancements and evolving global dynamics, presenting both new challenges and innovative solutions in risk management. The rapid pace of technological transformation is fundamentally reshaping how risks are identified, assessed, and mitigated. Artificial intelligence, AI, and machine learning algorithms are now employed to analyze vast data sets, detect subtle patterns, and predict market movements with unprecedented speed and accuracy, thereby refining risk models. Algorithmic trading, powered by AI, executes trades at speeds unimaginable just a few decades ago, introducing both efficiency and new forms of flash crashes and systemic vulnerabilities. The processing of big data allows for more comprehensive risk profiling and real-time monitoring of market sentiment. However, this increased reliance on technology introduces a critical new risk: cybersecurity. The digital infrastructure that underpins global finance is a prime target for malicious actors, making robust cybersecurity measures an absolute necessity to protect sensitive data, prevent system disruptions, and maintain market integrity. Alongside technological shifts, the regulatory environment continues to evolve, often in response to past crises. The evolution of stock market regulation aims to reduce systemic risks and protect investors. Macroprudential policies such as capital buffers and stress tests for financial institutions have been implemented to enhance the resilience of the banking sector and prevent future systemic meltdowns. These measures are designed to act as safeguards against the interconnectedness and potential contagion within the financial system. Furthermore, the emergence of new asset classes introduces novel risk profiles that demand careful consideration. Cryptocurrencies, for instance, offer high liquidity and the security of blockchain technology, but are also characterized by extreme price volatility and regulatory uncertainty, posing significant risks for investors. Stablecoins, designed to maintain a stable value relative to a fiat currency or commodity, are being integrated into payment systems, but their rapid adoption also raises questions about their potential impact on the traditional banking sector and broader financial stability. Even traditional safe haven assets like gold, while often seen as a hedge against inflation and economic uncertainty, exhibit their own price dynamics and risks influenced by global economic conditions, interest rates, and geopolitical events. Navigating this complex interplay of technology, regulation, and new asset classes requires continuous adaptation and a forward-looking approach to risk management. For individual traders, the theoretical understanding of risk and reward mathematics translates directly into practical strategies for navigating the markets. Forming a robust trading strategy begins with clearly defining an optimal risk-to-reward ratio for each potential trade. This ratio helps a trader decide if the potential profit justifies the potential loss. For example, a trader might only enter trades where the potential profit is at least twice the potential loss, 1-to-2 ratio. Crucial tools for implementing this are stop losses and take profits. A stop-loss order automatically closes a position when the price reaches a predetermined level, effectively capping potential losses. Conversely, a take-profit order closes a position when a desired profit level is reached, ensuring gains are locked in. These tools are indispensable for disciplined risk management, preventing emotional decisions from dictating outcomes. Beyond individual trades, effective portfolio management is paramount. The principles of diversification are fundamental for reducing non-systematic risk, the risk specific to a particular asset or industry that can be mitigated by holding a variety of assets. This involves spreading investments across different asset classes, industries, and geographical regions. Understanding the correlation between assets is also vital. Holding assets that move independently or inversely to each other can further stabilize a portfolio. Quantitative methods are continuously applied to assess investment risks within a portfolio, using metrics like standard deviation, beta, and VAR to monitor overall exposure. Finally, the financial markets are dynamic, constantly evolving. Therefore, continuous learning and adaptation are not merely beneficial but essential. Traders must remain vigilant, understanding the ever-changing market dynamics, economic indicators, and geopolitical events that can impact their positions. The ability to adapt strategies to new challenges and opportunities is a hallmark of successful trading. Furthermore, effective communication between marketing teams and technical teams within financial institutions is crucial for thoroughly assessing the risks associated with various financial products and services, including individual stocks, ensuring that both internal stakeholders and external clients have a clear and accurate understanding of potential outcomes. This holistic approach, combining mathematical rigor with practical application and continuous learning, empowers traders to make informed decisions in the face of inherent market uncertainties. Wall Street, throughout its storied history, remains an eternal battleground where the powerful forces of greed and fear perpetually clash, where relentless innovation constantly tests the boundaries of established regulation. The mathematics of risk and reward, far from being abstract concepts, serve as the indispensable compass for navigating this dynamic and often tumultuous system. The journey from intuitive hunches to sophisticated algorithms underscores a fundamental truth. While markets may appear chaotic, underlying principles govern their movements, and those who master these principles gain a significant advantage. The key lessons gleaned from centuries of Wall Street history are clear and profoundly relevant for modern traders. The paramount importance of knowledge, not just of market mechanics, but of historical patterns and human psychology. The unwavering necessity of discipline, to adhere to a well-defined strategy and manage emotions, and the critical ability to adapt, to continuously learn and adjust strategies in response to an ever-changing financial landscape. In this continuous game of probabilities and human behavior, understanding and applying the mathematics of risk and reward is not just an advantage, it is the ultimate guide to survival and prosperity. While mathematical models provide the framework, the individual's journey on Wall Street is ultimately a psychological one. The battle against one's own emotions, the discipline to adhere to a strategy, and the continuous pursuit of self-improvement remain paramount. For those seeking to master not just the mechanics but the very psychology of trading, to understand the timeless principles that govern individual success in the markets, there is one text that has stood the test of time, offering profound insights into the mind of a legendary trader. We are talking about the newly reissued Reminiscences of a Stock Operator. This isn't just a historical account. It is a deep dive into the psychology and strategies of Jesse Livermore, brought to life with expert commentary and analysis for each chapter, transforming his unparalleled experiences into actionable, practical lessons for today's market participants. It is a masterclass in understanding market dynamics and, more importantly, understanding oneself within those dynamics. Discover how timeless wisdom meets modern application by finding the link to this essential read in the description.